Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Friday, September 15, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And as you can see here, it looks like we were down from yesterday, but you have to realize that it was the end of the quarter today, and therefore the S&P, or pardon me, the SPDR, paid a dividend, and I believe the dividend was around $1.20, something like that. So therefore, it shows down 78 cents. So in a sense, the SPDR was up about 40 cents or so, something in that neighborhood. When you look at the cash S&P index, it was up between $4 and $5, so that makes sense. So we'll just say that the S&P or the SPY was up about 40 cents, give or take. And just to get a better picture of it, when you look over at the cash index, the SPX, you can see here that we're actually still making and potentially even breaking out from the bullish pattern that we talked about yesterday. It's a little early for that yet. However, I wouldn't be surprised to see more upward activity into early next week based on what we're seeing in front of us on the charts. As you can see today, in still looking at the SPX, which is the S&P 500 cash index, we hit a very big psychological number and closed there, which is 2,500. That's a big psychological round number. We hit it on a Friday leading into a weekend. We hit it on an options expiration. We hit it on a quadruple options expiration. So we'll see if that's really that meaningful and we're going to continue higher, or did they just want to achieve the 2,500 and then back off from that number? We'll know more next week, but I'm going to reserve any forecasting based on that for next week until we see more market activity. At this point in time, I'm not going to recommend anybody be short this market until and unless we see a sign of a reversal, some kind of high volume reversal day, some kind of indication that the market is changing trend. You can see here on the volume, this is again the cash index, there was quite a bit of volume today, but that's not due to the S&P being up 4.5 points. That's due to the quadruple witching options expiration. Just to compare that number, when you look at the previous quarter's options expiration, which was another quadruple witching option expiration, it was the 16th of June, and you can see here that there was a similar volume activity in the market. Here's the top of the volume bar, and we didn't even quite get to where we were in June. So it's not out of the ordinary for us to see a volume spike during quadruple witching or any options expiration for that matter. So I'm not going to read anything into the volume. It's past. We're done with this week. They hit the big round number at 2,500 in the cash index. Let's see what happens next week. We can't really take anything away from the market. It's been resilient. We had a pullback, but they couldn't send the market down any farther than we saw over here from the 21st of August. And from that point, that's where we found a low. We rallied back, busted through the high, and here we are at 2,500. So you have to tip your hat to the market. The cycle was wrong. I was wrong thus far. It doesn't mean the market can't go back down, just not in the way in which I anticipated happening. I anticipated the cycle beginning either late July, early August, and going down for two months, maybe 2.5 months, in that neighborhood. That's not what happened. Doesn't mean we can't go back down. Doesn't mean we won't go back down. Just didn't happen the way in which I anticipated. Listen, it's a tough business. I have to own it. I said what I thought was going to happen based on my work, and it turned out to be incorrect for the time being. I have to own it. It's a humbling business. It's a tough business. That's just the way the market works. What do I always say? It's designed to fool or make as many market participants look like fools as possible as much of the time. Well, here we are. I'm the court jester right now. I get it. I understand it. I've been doing this a long time, so I'm okay with owning that market call. The IWM pushed higher today, up about 0.5%. Again, we have to really wait because it was quadruple witching options expiration. We have to wait to see whether this is a real, breakout or potential run to all-time highs where we were over here. Okay, are we going to challenge the highs and break out, or are we going to fail here? And this is one of our non-confirmation signals of the highs that were made in the S&P 500. We have the IWM, we have the transports, we have the broker-dealers. We have non-confirmation signals, but yet again, we have new highs in the S&P 500, and we have to just respect that for what it is, and we tip our cap. Really nothing new to add in the IWM that we haven't talked about the last couple of days, so we'll just move it along, and we'll go over to the VIX. I've been talking about the VIX and how it was potentially making a higher low. Well, today we actually pierced through the low. Here's the low today was, I'll move this over. The low today was $10 even, and the low here, which we were looking for to make a higher low from, was 10.02. So we pierced through it by 2 pennies, bounced off that number, finished down at around 10.17 or at 10.17, and guess what? Here we are again, down in the $10 area. $10, below $10, into the nines, regardless of what anybody tells you. That's an area where you can buy the VIX. You just need time because it typically doesn't stay down here for very long. Sub $10, it's generally a buy. You can expect a rally off this level at some point in time. Whether it happens on Monday or Tuesday, we'll see, but certainly any lower push in the VIX, and I will be a buyer once again of the VIX because it doesn't stay down here for very long. We will get another rally in the VIX, and we obviously will get a correction at some point in the market. We'll see what happens at this 2,500 on the S&P. Looking over at the transports, here again is our another non-confirmation signal. We certainly had a pretty good rally off these lows. However, we're not anywhere near the all-time high in the transports. Same routine as the IWM. It's a non-confirmation signal, not taking anything away from the transports. We are right now making a bullish pattern, and this is potentially building energy for another push higher. We'll see what happens over the next few days, if in fact we do get another push higher. One thing I want to make mention of as we talk about the stock market and all the various indices is I think the market, which is interesting to me, is getting what I'll call NOCO fatigue. And we have heard this information coming from North Korea with a potential conflict, and they're firing missiles, and we're going to retaliate, and Trump's talking tough, and all this stuff. But what's happening now, and you can tell this pretty obvious, nobody cares. And when we get into that situation where bad news is just flat out ignored, it's interesting. It generally happens in an upcycle. I don't think we're in an upcycle. I think the cycle's still pointed down, even though the cycle that I had pointed out has failed. It doesn't mean that the market can't go down from a high of another number. The point is that from a seasonality perspective and a longer-term cycle perspective, we should be in a down cycle. However, we are ignoring, or the market is ignoring, important news that it generally doesn't and hasn't ignored. And I think we're getting this North Korea fatigue because nobody seems to care, especially within the market, that they fired another missile over Japan. Call me crazy, but that seems like important information, and it seems like Japan's not going to just ignore that indefinitely, and certainly not along with their allies, which we're one of. We're not going to ignore that indefinitely. We're not going to let this crazy guy out of North Korea continue to fire missile after missile after missile with no response. It just doesn't make any sense to me. However, what I wanted to point out is that the market seems to be ignoring that information, and I like to call that fatigue. It's the boy that cried wolf. You hear the same thing over and over and over again. After a while, it just becomes meaningless. However, at some point in the future, at some point in time, if there is a response, you can bet that that'll be front and center once again. It's interesting psychology, if for nothing else. Taking a look at the broker-dealer index, another non-confirmation. I mean, the broker-dealer index, while it's making a bullish pattern here, potentially going to press higher into the 50-period moving average, and we've consolidated and are consolidating beneath the 50-period moving average to where we'll probably bust through it. There's also a gap fill right above that, so it wouldn't be out of the ordinary for us to get up to like 230, for example, and that would fill the gap. We could potentially go higher than that. We'll see. I don't see new highs coming anytime soon in the broker-dealer index. So right now I'm watching it very closely. It's another of many non-confirmation signals to the S&P 500. May we live in interesting times. Looking over at the gold market, we did a retrace today of yesterday's candle that went down to test in and around the 20-period moving average. We made a test or a retracement about halfway down the pseudo doji candle, as I like to call them. That's normal garden variety market behavior. And if this market is bullish and continues in an uptrend like I think it will, I do think it's bullish, then we should see upward activity into next week. If it's not, and we do come down, we'll come down to the point we talked about last night, which was the breakout area. Markets like to come back down and test or come back up to test former breakout and former breakdown points. So at some point in time, we will come back down to the 1300 area to test that, although we are in an uptrend right now and the uptrend is holding. As long as the 20-period moving average holds and it continues to slope upward, gold is likely to go higher. Looking over at silver, silver's now coming down to test its 20-period moving average. It is also in an uptrend, and this could just be a pullback from a very overbought condition. Same thing in gold. It was overbought, pulling back. But these pullbacks are not necessarily bearish. These pullbacks are really building energy for another or the next move higher. So until and unless we break down below important areas, it remains bullish. And the same thing applies to silver that we just talked about in gold. Here's the breakout point. So silver, if it does want to come down much farther, it will come down to test the former breakout area. It'll want to check in at that point. This is certainly, at least at a bare minimum from an intraday perspective, this is a tradable area because we will get a bounce off this area. Same thing in gold, same thing in silver. It will come back to test this area if it does come down farther, and from at least an intraday perspective, you'll get a bounce from that area. Crude oil, nothing happened today. We're down a penny in crude oil. There's nothing new to add. Everything that we discussed in crude oil from last night and before remains intact. We're looking at a weekly chart pattern that looks to be like it's playing out. It is playing out. It doesn't look to be. It is playing out to the upside. We talked about it ad nauseum. I'm not going to belabor the point here. We're headed to the 50-period moving average and most likely beyond. 51.50 to 52 is my target in crude oil. Back to the daily chart, and we can leave crude oil and go over to the bond market. And the bond market didn't do much today. You can see yesterday we put in a doji candle, which was really in and around, you can call this a breakout area, consolidation area. When you draw a line over from where we came from, you can see we consolidated here, tried to break out, had to consolidate again, and then finally broke out. So we came down to check in at one of the last former consolidation points, and here we put in a doji candle, and likely story is we're going to go higher from here, at least for a few days in the bond market. Once again, garden variety market behavior. No real change from yesterday's activity. And the dollar saw some downward pressure today. Again, I'm not changing my stance. I think the dollar has downside to 88 cents on the dollar. At 88 cents on the dollar, I'm going to look for a reversal at that point. Until that point, I'm not short the dollar. I'm just waiting, letting it fall if it's going to fall. And if it gets to 88 cents on the dollar or slightly below that, I will be looking very closely for a reversal, a sign of a reversal. We're looking for, at that point in time, a high volume reversal in the dollar. Nothing's changed. And with that, I'm going to wrap it here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.